Hello, everybody. It is Hammer J. Helmer here with your vetted VA mortgage rate conversation for the week of August 3rd. And let's see, we'll throw a little slide up there. So, welcome. And today, what we're going to talk about is what's going on with mortgage rates, where they've been the last week or two, where we think they're going over the next few weeks and longer, and help to educate you so that you are comfortable with the interest rate that you're getting and that you know what you're being quoted and why you're being quoted that. And basically where rates are going. So if this does help you, let us know. Make a nice comment. Let us know that you're watching. Let us know that you like the information. You can join us each and every week around the same time. It's 12 p.m. Eastern. So, of course, you can do your math and figure out what time zone you're at from there. But 12 p.m. Eastern on Wednesdays, we do this where we kind of visit this rate conversation. And if you're watching on the replay, do me a favor. Just put a hashtag replay in the comments. Let us know that you are watching on the replay and that you find value in these as well. We do monitor the questions throughout the week. So if you do have any questions on anything we could talk about today, make sure you put that in the comments as well. And I am monitoring for live comments also. If you do have any live comments, we can answer those also. So what do we got going on this week? Well, I'm glad you asked. Let's go ahead and take a quick view. So first, let's recap what happened over the last week or so. Last week, mortgage rates did improve. And most of the reason that average mortgage rates improved was because of the Fed. So average mortgage rates improved once again last week, despite a strong inflation reading on Friday. And that was one of the things we were concerned about is inflation is the enemy of mortgage rates. And we've kind of talked about this before, and we'll kind of bring it up again. But basically right now, it's almost like a horse race. We've got fear of inflation and fear of recession. And these horses are battling it out. And depending on who's leading, is where mortgage rates are headed. So we did see last week rates actually did improve, even though we got that strong inflation reading, because fear of recession outweighed the fear of inflation. Now, the Fed raised the Fed funds rate 0.75 of a point on Wednesday. And that led to a lot of confusion. A lot of people were like, okay, hey, the Fed raised rates. That means mortgage rates go up, right? Well, it doesn't. The Fed actually doesn't set mortgage rates. Now, mortgage rates are heavily influenced by the Fed and by the Fed funds rate, the rate that the Fed actually does control. And we're going to talk about that in a minute about how we are actually seeing rates lose ground yesterday based on what we think the Fed is going to do in September. And that's how it works when it comes to this stuff, is that what happens in mortgage rates hits long before the Fed actually takes any action, because mortgage rates are going to move on the speculation of what that Fed action is going to be. So the Fed raised rates 0.75 of a point last week, but that actually helps mortgage rates. That actually helped mortgage rates to improve because it fights inflation, and inflation is what is pushing rates higher. So mortgage rates actually improved in the news, and because of the Fed's strong moves to fight inflation. Now, this week, I wrote this on August 1st, which was Monday, and we were really having a positive momentum, some positive stuff going on Monday, that it looked like rates could improve a little bit further. And I said, as the week starts, it looks like mortgage rates are poised to improve further, as recent economic data showed that the aggressive Fed rate hikes have started to slow the economy, which should help curb inflation. And I said there's speculation that runaway inflation has now peaked and that we could be seeing a tipping point where rates may move lower in August than what we averaged in July. All right. What's going on, sir? I see Facebook user there. I see someone commenting. Great to see you. And thanks for chatting. So, but that information, what I have up there as far as what the expectation was going into this week, has not panned out. And let me show you a little bit about why, and we'll talk a little bit about it. So first things first, let me pull this over. I want to show you guys what is it that actually that mortgage rates are moving and why. So I've got my little handy dandy notepad here. We're going to talk about this, right? So we want to talk about where are rates moving to and why. If you're looking at buying a home, if you're thinking of refinancing, this is probably why you want to tune in. You want to get an independent, arbitrary view of what's going on, and then maybe a little bit of a forecast, right? And we can figure out why things are happening. So first of all, let's talk about the next couple of weeks, right? When we look at the next couple of weeks, what's going on with mortgage rates and why. So the next couple of weeks, right now, we've got Friday, we've got jobs data. So Friday jobs data is possibly going to influence mortgage rates this week. If the jobs data comes in strong, showing that the labor market continues to perform well, meaning that we don't see unemployment increase, we don't see wages start to lose ground. If that comes in strong, that shows strength for the economy. Strength for the economy is not necessarily what we want to see right now. As much as we want the economy to do well, but for mortgage rates, strength in the economy means mortgage rates are going to tend to push up. So if we get strong jobs data on Friday of this week, a couple days from now, that's a very good chance that could pressure rates a little bit higher. Will it be a lot higher? No, you're not going to see rates jump 0.5%, but rates could move a little bit higher. The costs of your rebate pricing, that credit you get on your closing costs or your cost to get a better rate, could get a little bit worse on Friday. Now, also, rates this week and over the next couple of weeks, rates this week, they're actually moving a little bit negative. And let me show you why. So everything is based on what happens in the market. Where do mortgage rates come from? Let me go ahead and let's pop this like this, right? So let's move this over and let's say, where do mortgage rates come from? All right, so we've talked about this before. There's actually two components that are going to come into what rate you pay on a mortgage. The first one is mortgage-backed securities. So mortgage-backed securities. We've talked about this before, and for those that may not have been part of that conversation, mortgage-backed securities, they are this fancy chart that you're looking at here. And what happens is we're tracking the price that mortgage-backed securities, which are a bond, we're tracking the price that they sell for. The more that they sell for, the better your interest rates are going to get. The worse that they sell for, if this number goes down, the worse your interest rates get. So we're tracking this. You'll see right here, this column shows values going up, values coming down. So if we see that these candlesticks move in this direction, and you know what, we're going to go ahead and just move this into a line chart just to make it a little bit easier to understand for today. So if we follow this path, as these lines move higher, that means mortgage rates improve. As they come lower, that means mortgage rates get worse. Now, we're looking back at the last 6 months. So we're looking back from almost the beginning of the year. And you'll see that relationships. We saw, if you look down here along the bottom, you're going to see, in fact, let me just make this full screen so I'll get my head out of the way. And bear with me a second. And there you go. All right. So if you look down at the bottom here, you're going to see the dates. So this is February, then March, then April, then May, then June, then July, then August. And here's the timeline for this chart. And we can see that as the value on these bonds went lower and lower and lower, what happened to mortgage rates? Mortgage rates went higher and higher and higher. We saw that case where they went from the 3s to the 4s to the 5s. And in June, we actually saw them move up into the 6s. Right about here, right around June 14th, we saw some of the lowest level for mortgage bonds. You see this big drop, and this is when interest rates hit their peak. Since then, we've seen some recovery. So you see a direct relationship. As the value of these bonds improves, so does your mortgage rate. So that's the first place where your rates are going to come from, is the market. Mortgage-backed securities. The more they sell for, the better your rate. The more they sell for, the better your rate. So that's number one. Number two, which adds to this. Actually, I don't want to put that. It looks confusing. So first thing is, what are mortgage-backed securities selling for? And then the next thing is plus your lender margin. So this is why you want to shop around and make sure that you're comfortable with who you're working with. Different lenders are going to have different margins based on required profits, costs, etc. Okay, so different lenders are going to have different margins. So this always going to be the same. This varies. Okay, so this part is always the same. This part varies. And that's why you want to go ahead and take a look at who you're working with and that kind of a thing. So, but when we go back and we look at mortgage bonds, let's take a minute here and talk about kind of what's happened here and what that looks like. So, looking here at mortgage bonds, we have seen last week, we saw a big run up. Do you see that right here? See how these lines move up? We saw a big run up. We hit levels that we haven't seen since May, and that's why interest rates improved. But what are we seeing now? We've seen a big drop. Yesterday, we saw a really big drop. And what caused that? Why did we see a drop? What could we have seen coming? And what did we expect? Well, first thing, do you see this purple line? When we look at these technical charts, we're looking at what we call support levels, which shows us, hey, we shouldn't see things get any worse than this. And we look at what we call resistance levels, which says it may be harder to improve from here. And when we look here, this purple line, this is what's called a 100-day moving average. And it's a very strong technical resistance level. So when we broke above it, that's a great sign that things could improve, but it also shows a lot of risk. And once we break above it, we're looking for what happened the next day, which was, hey, we fell back below it. We significantly dropped below it. Now you see this red and green line. These are the 50 and 25-day moving averages. Those are forming a level right here, and you can see that it kind of corresponds with this drop and this valley right here. This is actually what we're looking at for support. So when we're forecasting where rates and pricing are going to go, when you say, Hammer, how do you think you know what's going to happen? It's like the Weather Channel, right? We have certain indicators that show us that these are the conditions that exist that will lead to these results. Now, I don't have a crystal ball. I can't guarantee you what's going to happen, but I can tell you why we think things are going to happen. And I want you to be educated as consumers so that you feel comfortable with that conversation with your loan originator, your mortgage broker, your loan officer, whatever title that they're using. But the person that's helping you get your loan done and get that mortgage, I want you to feel comfortable so that you could say, hey, this is what I've heard is going on and how's this affecting my rates, right? So taking a look here, when we see this, and it's a little bit small. Let me switch to the other view so we can make it a little bit bigger, right? So when we look here, we've seen that fall back down. Now we're going to look for some support at these levels, meaning we don't think that we're going to see rates get too high from here, but they have moved up. They have moved up a little bit over the last couple of days. So if you had gotten a rate quote just a couple of days ago, if you got a rate quote on Monday, and then you get that same person to give you a rate quote today, you're going to find that there's a difference. And the reason that we see a difference is based on mortgage-backed securities and the market. The market has shifted. The market has moved. Because of that, so has your mortgage rate. So you might see that rates are a little bit higher than they were on Monday, but they're better than they were last week or in the last couple of months, and especially going all the way back to the middle of June. So rates are still, as a general rule, they're still better than what we saw early in July, towards the middle of July. So we're still seeing a little bit better rates, and that's a good thing. Now, so that kind of brings us back to that spot here of, okay, what do we think is going to happen over the next couple of weeks? Well, we look at Friday's jobs data, and that could cause markets here to react, and we could see a negative reaction, which would cause mortgage rates to get a little bit worse. So between now and then the rest of the week, you may want to decide, hey, I don't know that we're going to see a lot of improvement here. What is our risk versus reward? And when you make a decision about locking or floating your loan, that's what we're always looking at. We're looking at risk versus reward. Okay, what is the potential of risk that we may see rates get worse versus what is the possibility of a reward that we may see rates get better? How much better could they get? So right now, if we look at this ratio in the next couple of weeks, right? In the next couple of weeks, we're looking at a higher risk and lower reward. It's not likely that we're going to see things get significantly lower. Now, many VA loans are already in the fours. You may be in the mid to high fours. And one thing you may notice is that VA loans are generally pricing, their rates are better than conventional loans. And that's one of many reasons that you want to try to utilize your VA loan benefit and, and use a VA mortgage for buying your home or if you're refinancing. So, but the risk that things could get a little bit higher, is higher than the reward that things may get a little bit lower. So over the next couple of weeks, you want to factor that in. It may be a good time to talk with your mortgage professional about locking in an interest rate if that's the right decision for you. And again, that's going to vary from person to person and situation to situation. So talk to your professional that you trust and let them guide you on that, whether it might be a good time. But if it were me, I'm thinking if my loan is closing over the next couple of weeks, meaning you're already in a purchase transaction, it's closing soon, or you're in a refinance, I would probably take the chips off the table, take the money and run. Rates are at a really good spot right now. Don't necessarily need to push it to the limit. I think that it's a good time to take that. Now, if you don't, what happens is we may see some negative moves on that job data on Friday, and that could cause rates to get a little bit higher. And next thing you know, you're pinched by that window, because if you're closing in the next couple of weeks, you don't have much time. So we may not see a recovery. We may not see things improve over time. You may not have enough time for that. So that's why it makes a good thing to do that. Now, let's answer some of the questions. Do I think mortgage rates have peaked? Yes, I do. I think they peaked in June at that 6% mark, which we talked about. If I go back here and we show that low point in mortgage bonds in the market, when there was a lot of risk of inflation. We got an inflation reading that really took the markets by storm. And the idea was that inflation was continuing to go and get worse. And that's why rates continued to go higher. I think rates peaked then. Also, the expectation of Fed action. So to answer the question, have rates peaked? Yes, I think mortgage rates have peaked. Next question, long-term rates, 3 to 6 months, 12 to 18 months. So let's talk a little bit about that. Let's go through and let me pull this over and let's go into that next one and talk about what is. So I say near term is generally anything closing in the next couple of weeks. I say anything that's closing in 15 to 30 days, call it by the end of the month. I call that midterm. And then longer term is anything that's outside of 30 days. You can't really forecast 12 to 18 months from now. That tends to be a very, very difficult ask. We could talk about what could be and why, but it's of course, the longer we go out, the likelihood of a forecast being accurate goes down. I can be very accurate within the next couple of weeks and even into that midterm here. So what happens, because we know what's affecting rates, and that's kind of what we'll dial in on. So when let's see, the next question is, how do we decide if we take the rate free of charge versus take the higher rate for a credit? So that is a great question. Let's go ahead and talk about that for a minute, and then we'll come back to some of these other things, right? So rate. Oops, sorry, that doesn't make any sense with a W there, does it? So rate with no fees or credits. That's usually your option one, right? Then you can get higher rate with credit towards your closing costs I'm talking about. And here, I'll make this a little bit bigger and be a little smaller so you guys can see it a little better. There we go. And then number 3, lower rate. You can buy down your rate with costs. So these are your 3 options generally, and they may or may not exist for every person in every situation. But as a generality, these are the options you're going to have when you're getting your mortgage. So you're looking at a rate with no fees or credits. That's what we call par, by the way. That is what we call a par rate in the industry. Then you have a higher rate with credits. This is a premium priced situation, we call this in the industry, premium pricing. And what that means is that you're going to receive a premium back to help pay your closing costs, but you're going to get a little bit of a higher rate with that, and then lower rates with costs, and you are buying down your rate, right? So this is a buy down or buying down your rate here. So there's different times that you would choose these. So of course, first of all, how much money do you have to work with, right? That's of course going to be part of the decision, so one thing, how much money do you have to work with is certainly important. The next thing, where do you think rates are going? This is an important one, because what happens is when you are looking at a situation where you think rates are going to improve, and that's what I think is going to happen in 2022 and into 2023. Let's say that you get an interest rate today just a round number. Let's say that you get an interest rate of, and I'll do this, of 5%, right? Well, if you get 5% and you get a credit, so we're going to put a plus symbol there, and you get $2,000 towards your closing costs, right? And you think interest rates are going to improve at the end of the year, you can refinance, and your VA loan has an amazing product called an EARL, which is a interest rate rapid reduction loan. Okay. So you have the ability to do a refinance that is very, very streamlined and to get that lower interest rate. So you may take that higher interest rate, which means it's going to come with a higher payment. Let's say your payment is $15, $20, $30, $40, $50, $60 higher, but maybe you spend 6 months in that loan with the higher payment. Then you do an EARL, and now your interest rate, let's say, went down to 4%. So you're still up that money. The lender is giving you a credit that you can use towards your closing costs or expenses, and you can then refinance. So if you think rates are going to improve, this may make sense for you. But you also, of course, have to weigh, what if rates don't improve? Are you comfortable with that payment at that rate? The second thing that happens, though, is the other equation that we had here is, depending on where we think rates are going, what if you want to take a lower rate with costs? And what that looks like, if we pull that over here, that one, let's say that's a totally different scenario. Okay. Let's say that you, instead of getting 5%, you buy 4% now, but it costs you $2,000, right? So let's say it costs you $2,000 to get this better interest rate. You're buying it down, right? You're buying that interest rate down. Well, what happens in 4 months if rates get better? What if you could have refinanced from 5% to 4% and it cost you better than that and it would have not cost you $2,000? Or what if rates, and again, these are just fake numbers. This is not where I think rates are going. Let me be very clear there. Let's say we think rates drop all the way to 3% though. And then you refinance from 4 to 3 because that makes sense. Well, that money that you spent here, it's gone. It's gone. It's gone. So what you want to do is you want to look at, when you're making that decision of whether you're going to take a credit, whether you're going to pay a cost, you want to figure out a couple of things. Is, first of all, how much money do you have and can you afford? Is it going to help you? Is it going to help you to go into your home with some money in your pocket that you would have normally have had to put down instead? Maybe that's a good decision to have a little bit more of a cushion, have a little buffer, have a little bit in the savings. Or where do you think rates are going? And again, for me, as we've talked about, I think rates are going to improve by the end of August. I think we're going to see them improve or the same. Okay, so it's by the end of August, we are right now in a really good spot with interest rates. We've seen rates come down pretty significantly over the last couple of weeks. In some cases, they've come down 0.25%. Some cases, we've seen 0.5%. It depends on your lender, right? But we've seen a significant move, but we've seen some of the best rates we've had since May or June. We've seen some really good rates. So I think we will improve a little bit, or will be about the same by the end of August. And the reason for that is because the fear of recession is going to increase, and we're going to see things, continue that way. And by the end of the year, I think rates will continue to improve. The reason that I think rates will continue to improve is because the economy will slow down. The economy will slow down, and we're going to see the economy slow down, and we're going to see the recession hit, which some people argue we're in a recession right now, and we're going to see inflation drop. So these are the reasons that I would say that I think things are going to improve the rest of the year, because the economy is going to slow down. We're going to see recession. We're going to see inflation drops. And by the end of August, we're going to improve. Someone said, after we close, how long do we have to wait to do an EARL? And will we have to do credit check and pay closing costs? So that is a question that you would definitely want to talk to whoever is helping you with your first loan to get the details and have them answer it in full. But to answer that for you, you have to wait a little bit more than 6 months, 210 days, I believe. I'm not a VA. I am not a vetted VA expert. We have lots of vetted VA experts. It's a great question to ask in the group. We can get someone to tag to answer. I'll do my math on that one. I'm the rates and the markets guy, as you can tell. So, but I believe it's 210 days. If there are any vetted VA professionals that are on, if you could confirm that, that would be great. If you could vet that information for me. But I believe it's 210 days for an IRRRL before you're able to take that refinance, which is about 6 months. It's a little over 6 months. Actually, I think it puts you at your seventh. I think you have to make 6 payments. So it puts you at about your 7th month. And then credit check. I would rather get you that data than answer that for you on whether there is a credit check required. You already have a VA mortgage, so as long as it's in good standing, I don't think you have any problem doing an IRRRL, but I will find out about the credit check. And as far as paying closing costs, there are some, but they are reduced because it is a rapid refinance loan. So that is a great question, though. I will get one of the vetted VA moderators to find out and answer for you, and we'll make sure we answer that one in the group. Next question is, it would depend on how long you plan to stay in the home and when you will break even. That looks like one of our professionals answering. So it would also depend on your closing cost goals and monthly payment goals. It would be best that individually answered between you and your loan officer, so they're totally dialed into your situation. I absolutely agree. Oh, I didn't even realize I could do this. This is some cool things. I absolutely agree with this. So the question was, if we decide to take the rate free of charge versus a higher rate for a credit, and the answer, which I gave, kind of explained to you with a few different scenarios here on what worked. Is this still displaying on here properly for me? I'm not, there it goes. All right. So we talked about, those different things. And then a great answer for that was it would depend on how long you plan to stay in the home, when it will break even. And that, you should definitely have that individually answered, so you're totally dialed into your situation. So next question that we just answered was, how long do you have to wait to do an IRRRL? And again, that's also one we'll get you some answers. So, all right, my friends. Well, that was awesome. Does anyone have any other questions about rates, markets, pricing? Of course, if you have any questions at all, we can get any of our wonderful vetted VA moderators to answer those questions for you. But otherwise, my goal is to just kind of explain to you guys where things are going in the mortgage rate market, why we think that's going to happen, and help you to be educated and informed to make a decision on when you think it's the right time to go ahead and lock in an interest rate and when interest rate is appropriate for you. Are there any other comments? Doesn't look like there are. Awesome. So if today was helpful, do us a favor, go ahead and definitely let me know in the comments if you found today helpful. Also, if you're watching on the replay, do me a favor, put #replay in the comments. Let me know that you did watch this on the replay. Remember, you can join us each week to discuss mortgage rates, 12 p.m. Eastern Time, 11 a.m. Central, 10 a.m. Mountain, and 9 a.m. Pacific. If you do have any questions, put them in this thread. We do monitor this post for you as far as interest rates go. And that's it, my friends. So again, I am Hammer, and thank you so much for joining me. Appreciate y'all. And I hope you guys have a fantastic week, and we'll see you next week. Take care, everybody. Bye-bye.